You have probably watched countless videos on smart money and ICT concepts, trying to figure out and learn what the secret method is for trading using these concepts to become a profitable trader. Despite this, you are still failing as a smart money trader, unable to consistently make profit. This can be due to limited access to information, lack of patience, emotional bias, risk management, or many other different reasons. However, the main secret to becoming a profitable ICT and smart money concept trader is that there is no secret. By looking for a hidden method to become profitable 100% of the time, you will eventually give up. This is because there is no hidden or secret smart money and ICT concept trading method. If you understand that there is no secret shortcut or hidden method to guaranteed profits in smart money and ICT concept trading, you can free yourself from the illusion of finding a magic formula. Instead of endlessly searching for a secret, it is essential to focus on learning and implementing the core concepts and elements of these strategies. In this video, we will thoroughly go through and discuss these concepts, giving you the knowledge and tools necessary to effectively apply these strategies and concepts to enter into profitable positions. Before we can enter into a trade, we will need to find a good setup. In order to find these setups, we will be looking for areas of interest to spot entries in. The first method we can use to spot these areas with is liquidity grabs. We can see here that the price action was in a downtrend. We can also see that after the downtrend formed, the price found support at this price level. Once price found support at the level and proceeded to go in the upward direction, many retail traders would have entered into the position and put their stop loss at the support level, due to them thinking that this was a valid retest. However, as you can see, after the small bullish move, the price made a sharp move to the downside. After the sharp move was made, the price continues in the bullish direction and actually starts making higher highs and lows, meaning that a bullish trend started. The sharp move that would have stopped retail traders out of their trade is known as a liquidity grab. Smart money knows that many retail traders will place their stop loss at this level. Because of this, the price is pushed downwards, allowing smart money to enter into a large position by grabbing liquidity from the retail traders being stopped out. A different concept we can use for finding key areas to enter into a position is order blocks. Simply said, order blocks are levels in the market with significant clusters of orders. These blocks can act as support or resistance levels, providing opportunities for traders to enter or exit positions. Here we can see an example of this. The price was in an uptrend but made an aggressive move to the downside once it reached this price level. Let's mark this level and observe how the price reacts to it. As you can see, after the price reached this level for the second time, the price made a sharp move to the downside again, causing for a large bearish candlestick to form. This indicates that there are a lot of sell orders at this price level, indicating that traders should enter into sell positions once the price reaches the bearish order block. There are also order blocks that form due to tight consolidation. Say you are a bank that wants to buy 300 million in Euro USD, however, currently there is only 75 million available. If they were to place the order, the price would skyrocket, forcing the bank to buy large quantities at prices that are very high. The solution for this is splitting the $300 million position into smaller orders, allowing the bank to slowly fill the position. This process causes for a tight range to be created, which will become the order block. Here we can see an example of this. A tight consolidation period formed in the middle of a bearish trend. After this tight consolidation, the price continued in the bearish direction, which means that a bearish order block was created here. If we take a look at the price action that formed after the order block was created, we can see that the price pulls back to this zone multiple times. Despite this, the price finds it hard to break through this zone, showing us the strength that an order block has. Here we can see a different example of a bullish order block. A tight consolidation period formed. After the formation of this consolidation period, the price made a move in the upward direction, making this zone a bullish order block. Because of this, let's plot a box on this price level to make the order block easier to see. If we take a look at how the price reacts to the zone, we can see that the price got close to but respected the order block multiple times. If you are having a hard time spotting the order blocks, you can also use an indicator, such as the order block finder. Navigate to the indicator search tab and search for the order block finder indicator. Select the indicator made by this TradingView user and add it to the chart. As you can see, with this indicator added to the chart, we can easily spot both bullish and bearish order blocks. Make sure to validate these before applying and using the order blocks provided by the indicator. The next method for spotting key areas we will be looking at is inducement. This term may seem very complicated, however, inducement is actually a very simple concept. We can see here that the market is trending. Despite this, the market isn't moving in a straight line, only plotting bullish candlesticks. This is often the case. The counter-trend moves that form during the bullish move are caused by liquidity hunts happening on lower time frames. Inducement is when the short-term lows or highs of these small counter-trend moves are targeted. By targeting these short-term lows or highs, the smart money can grab liquidity before allowing the price action to continue moving in the longer-term trend. Here we see a different instance of this happening. The price was in an uptrend. During this uptrend, a low was created. After the low was created, the price moved even lower, stopping out retail traders that placed their stop losses at this level on lower time frames, before continuing in the upwards direction. After this move, a similar move happened while the uptrend was being resumed. The final key area we will be looking for are highs and lows. The term is already quite self-explanatory. The highest point that the price reaches before moving in the downward direction is considered the high. Conversely, the lowest point the price reaches before moving in the upward direction is considered the low. Now that we know the key areas to look for entries in, let's take a look at the ICT and smart money concepts we can use to find exact entry points. The first concept we will be looking at for this is the fair value gaps. Let's first properly understand what a fair value gap is. A simple analogy for a fair value gap is moving a crayon really fast over a piece of paper. If we do this, then you will see that small gaps will appear. This is because by moving the crayon very fast, the color won't be filled in properly, meaning that imbalances are created. This is the underlying thought behind fair value gaps. Here we can see a large bullish candle. This means that during the move that was being made here, there was only buying pressure. To draw the fair value gap, you will need to select the box tool from the toolbar on the right. After that, we will draw the box from the upper wick of the previous candle and the lower wick of the following candle. Once you have done this, you can extend the box into the future. This is a fair value gap, a 3-candlestick pattern where in the case of a bullish fair value gap, the first candle's high does not overlap with the third candle's low. Here we can see an example of a bearish fair value gap. We can see here that the price was moving in the downward direction. If we take a look at these 3 candlesticks, we can see that the first candle's low does not overlap with the third candle's high. The zone where the wicks of the outer candlesticks didn't overlap forms the bearish fair value gap. So why are these fair value gaps important to traders? Well, fair value gaps act as a magnet for the price action. Due to the imbalance that is formed, traders often believe that the price will eventually move towards filling the fair value gap. In the previous bullish entry, we can see that this was the case. The price headed to the fair value gap before heading back up. If we look at the previous bearish entry, we can see that the price indeed reached the bearish fair value gap before heading back down in the bearish direction. If you are having trouble spotting fair value gaps, you can add an indicator to the chart to simplify the process of finding the fair value gaps. But before that, if you are looking for a crypto exchange that currently has some of the lowest fees when it comes to futures and spot trading and up to a $30,000 bonus, then check out the link in the description of the video to get access to all of these perks. Head over to the Indicator Search tab and search for the Fair Value Gap indicator. Select the first indicator from the search results and add it to the chart. As you can see, now that we have added the indicator to the chart, we can see both bullish and bearish fair value gaps that have formed. As you can see, the indicator shows fair value gaps that haven't been filled yet, allowing us to easily spot unfilled gaps. A concept that is similar to and involves fair value gaps is the balanced price range. A balanced price range occurs when there is a rapid and forceful upward movement in price, followed immediately by a sharp downward movement, or vice versa, where a steep decline is followed by a swift upward surge. Here we can see an example of this. A large bullish candlestick formed after which a large bearish candlestick formed. As a result of these aggressive back and forth price swings, what remains on the chart is essentially a double fair value gap, which holds a significant influence over price behavior and can act as a magnet for future price action. The most important and powerful smart money and ICT concept that can be used to enter into positions is the market structure. Here we can see a simplified version of the market. It's clear that the market is in an uptrend because of the higher highs and higher lows that are being made. Let's mark the points at which the higher highs and higher lows are made to make this clearer. The first concept that we can apply that is related to the market structure is the break of structure. Every time the price breaks above a previous high, this is considered a break of structure. This means that all of these points are considered bullish breaks of structure. After the bullish trend has played out, the price will eventually start moving in the bearish direction. If the price action breaks below the previous high or low, we consider this a chalk, which means that a change of character has occurred. Once the price action continues moving in the downward direction, making lower lows, every time a previous low is created, we consider this a bearish break of structure. So to summarize, a bullish price structure played out here where the price continued making bullish breaks of structure. Once the change of character occurred due to the price breaking below the previous high or low, the market switched to a bearish price structure by continuously making bearish breaks of structure. These patterns can be spotted manually. However, if you are interested in using an indicator to spot the break of structures and change of character, you can use a premium indicator such as the price action concepts by Lux Algo. As you can see, with this indicator we can easily know when changes occur in the market structure. Along with this, the indicator also plots different labels to show us what type of market structure change was made. We will be manually spotting the market structure changes. However, if you are interested in the Lux Algo Premium Indicator package, which consists of this indicator, along with many other premium indicators, then check out the link in the description to try out this indicator package for free for 30 days. Now that we know all of the basic key areas that we should be looking for in the market, along with which concepts can be used to find entries, let's apply it to the chart and showcase entries that can be made by combining these concepts. In this case, when looking at the price action, it is hard to determine what the trend is and what type of market structure is forming. Because of this, let's draw lines for each move to simplify the price action and add labels for when a break of structure or change of character occurs. Now that we have done this, we immediately have a clearer view of the trend and market structure. First, we see that a change of character occurred at this point. Right after the change of character, the price made a bullish break of the structure before making a bearish change of character again. During the bullish move, we can see that two fair value gaps were made. Let's draw two boxes around them to make them easier to see. After the bearish change of character, we see that the price action filled the first bullish fair value gap. After grabbing liquidity, the price moves back up, performing a change of character along with a bullish break of structure. The final move we see is a bearish change of character. Notice how we don't consider this move the high or low, and instead consider it a change of character only once the price crossed below this high or low. This is because the previous move was extremely small, making it likely for false change of characters to occur if we considered it. Since the price action moved in the bullish direction after reaching the previous fair value gap, let's wait for the second fair value gap to be filled before analyzing the market again. We can see here that the price has now also wicked into the second bullish fair value gap. This move can also be seen as a liquidity grab because it is likely that many retail traders set their stop loss at this level. Along with this, we can see that after the price wicked into the bullish fair value gap, a bullish change of character occurred, confirming the bullish sentiment and making it likely for the price to continue in the upward direction. Because of this, let's enter into a buy position here. We will be placing the stop loss at a recent swing low. Despite this seeming like the swing low, there is a chance that the price will be pushed out in order to stop out retail traders. Because of this, let's place the stop loss here. For the take profit, we will be targeting around a 2 times risk to reward ratio, since this also aligns with a previous high that was made. Now let's see how the trade plays out. In our analysis, we can observe the current upward movement of the price, indicating a bullish trend. If we examine the previous price action, we can identify a significant high that was formed. If we take a closer look at the previous high, we notice the presence of a bearish fair value gap that remains unfilled. Let's draw a box around this fair value gap and extend it into the future to make it more clear. This unfilled gap suggests that there might be an opportunity for the price to revisit this level in the future. Therefore, we will wait for the price to reach this fair value gap before conducting a thorough analysis. As we closely monitor the market, we witness the price briefly dipping into the bearish fair value gap, which can be attributed to a liquidity grab. This liquidity grab occurs when market participants strategically drive the price into a specific area to trigger stop orders or gather liquidity before swiftly reversing the direction. This action results in a change of character to bearish sentiment, as indicated by the downward movement following the liquidity grab. However, despite the emergence of this bearish change of character, we decide not to enter into a sell position just yet. This cautious approach is justified by the fact that the price previously exhibited a tight trading range in the current zone. Such a range-bound behavior suggests that this zone may act as a resistance area when the price attempts to break through it. Thus, it becomes a good idea to await for the confirmation of the price reaching this zone before considering a sell position. We can see that the price has now reached the zone. After reaching the anticipated zone, the price immediately experiences a temporary upward movement for another liquidity grab before resuming its downward trajectory. This sequence of events presents an opportune moment to enter into a sell position, as it indicates a continuation of the bearish sentiment. With the price action aligning with our analysis, we can confidently decide to enter into the sell position at this point. To manage the risk associated with this trade, we will set the stop-loss order at the recent swing high. By placing the stop-loss at this level, we aim to protect our position in case the price exhibits a sudden upward reversal or breaks out of the expected bearish trend due to unforeseen market dynamics. For the take-profit level, we will target the previous tight range that occurred in the price action. This range has demonstrated significance in the past, making it a potential area where the price may encounter support or a temporary pause in the price action. Setting our sights on this range allows us to establish a risk-to-reward ratio of approximately 1.6, ensuring a favorable balance between the potential gain and the risk undertaken. Now let's see how the trade plays out. Here we can see the following. The price was in a small uptrend, characterized by higher highs and lows, along with the 3 bullish breaks of structure. During this uptrend, we can see that a bullish fair value gap was created. Let's draw a box to clearly visualize the fair value gap. Once you have done that, extend the fair value gap into the future. We can see here that the price seemed to try to wick down to the fair value gap, but failed in doing so. After this bullish market structure, a bearish change of character occurred where the price did fill the bullish fair value gap. Following this move, the price continued back in the upward direction. The bullish sentiment is further confirmed by the fact that the level that was reached by the price action was previously used as both a support and resistance zone. Because of this, let's enter into the buy position here. We will be placing the stop loss at the recent swing low. For the take profit, we will be targeting this high, aiming for a risk-to-reward ratio of around 2. Now let's see how the trade plays out. I hope this video could help you understand ICT and smart money concepts, along with showing you how they can be used and applied to enter into profitable positions. If you did, and enjoyed the video, we would greatly appreciate it if you subscribe to the channel. Thanks for watching.